Hello, I'm Nick from Income Digs, and welcome to this video tutorial where we show you exactly the different tools we use to execute the various business processes within the world of real estate investing. Today's video is an extension of the previous two videos, Real Estate Accounting, where we showed you how to record a journal entry for the purchase of property. So this video will get a little bit more specific and honestly a little bit more realistic as we add in financing to the deal. So we add a loan into the deal. Now, in the previous two videos, we considered a cash closing, meaning that me or my company was coming to the closing table with the available cash to close the deal. That may be the case, it often is. However, I would say more often than not, especially when you're just starting out, you're going to have some kind of financing associated with a deal, whether that be from a private investor or from a bank. You'll have some kind of loan associated with it. So we're going to show you exactly how that works, what that looks like on the closing statement, and then how to translate that to the journal entry we made. So looking at our balance sheet, this is exactly how we left it at the end of the last video where we had done the cash purchase, okay? All we're going to do here is we're going to keep everything how it was, but we're just going to edit that existing journal entry much like we did last time when we added the escrow information. So we'll come back to that and we will adjust that journal entry. But if we shift over to our closing statement, I'll show you what the financing would look like on there. The top part of the closing statement that we've already looked at will stay the same. It's very much independent from financing. So our credits to the seller, they don't care about financing at all. My deposit is still intact, my $1,000, and then the fees that I have to pay for recording title insurance, all those things, those stay the same. So this total needed to close number stays the exact same at $102,449. Where things change is right after that. So then we have the financing section. We didn't have it before because we had no financing. I was coming to the table with cash. But we're assuming now that we have a loan. So let's assume that we have a private investor named Joe, and he's going to loan us $75,000 for this deal. Now you'll recall that the purchase price is $100,000, so he's loaning us $75,000, which is a 75% LTV or loan to value. Now that is a very common number with banks, especially that many banks won't loan over that amount. Many private investors will, but let's just say that Joe is a bit conservative. He wants to act like a bank in this sense and loan just 75% of the value. So he's going to give us that loan. Now, in addition to the loan from Joe, we have some additional costs that will come with that loan. The first is mortgage tax. So depending on the county you're in, the state and county you're in, you'll have to pay a tax when you record a mortgage. So when Joe loans me this money, we're going to file a mortgage with the county saying that if something happens where I'm not paying Joe, he can foreclose on the property. Same thing would happen if you were buying your own residence. The bank will record that mortgage and the associated mortgage tax with it. There's also the recording fees to record that mortgage. And then I included here investor attorney fees. So a really good way to incentivize private investors is to make it what's called a no-cost loan. And that just means that you're going to pay for everything. You're going to pay for all the mortgage tax, recording fees. You're also going to pay for their attorney fees. So if they prefer to have their attorney prepare documentation, they're going to get charged for that. And it's good practice, at least we've seen it to be good practice, to pay for this. That way, the lender, all they have to do is shell out the loan to you, and everything else is you cover, and they can take their interest, and it's very simple for them. So what that does is we're getting the $75,000 at closing, and then we have some additional fees. So all we do is we take that $102,449, we take out the $75,000, but we add back the $750, the $175, and the $600, and it gets us a total cash needed to close of $28,974. Okay, so obviously in the previous example we needed to come to the table with $102,449. This is a lot less cash for us to come to the table to close on. So in this case, it would be great, depending on the terms of the loan, of course, it would be great to have financing for this deal. Let's shift back over to the balance sheet, and I'm going to drill down to get into that journal entry that I did. And we're going to just edit this journal entry a bit. most everything is going to stay the same. But what we're going to do here is I'm not coming to the table with 102,449. So this total amount for my checking account is not that amount. What is that amount? It's 28,974. We see it down here. That's how much I'm going to have to take out of my checking account. So I'm going to go ahead and make that change. Now when I do that, obviously our credits and debits no longer match. So we're going to have to even those up a bit. So I'm going to go down here, and the first thing I'm going to do is add the mortgage. So we have a loan that we're getting from Joe, the private investor. So I have to add that here. Now I don't have it set up yet in my chart of accounts, so I'm going to set it up right now. I'm just going to start typing what I want to call it. So I'm going to call it 123 Main Loan. Now I don't have it yet, so it gives me the option to add it. I'll click Add, and now, like we did before, I have to select the category. Now I put my mortgages under long-term liabilities, so this is a loan that I'm going to pay off over more than a year, so I call it a long-term liability. We'll call it a note payable. I'll put a description in here. I'll put loan from Joe, the private investor. Okay. How much is this loan worth? It's worth $75,000. So I'm going to type in $75,000. I'm going to put in the description, loan from Joe. I'm going to add Joe the investor. Perfect. Okay, so that's there, and we're almost done. The only thing is that these still don't match, and that's because I have those additional costs associated with the financing that I have to add. So I'm going to start putting those in. So the first, let's call it professional services in the amount of $750, and this is for mortgage tax. Another professional services, $175. Let's call this recording fees. And lastly, one more for legal fees. And that's for $600. And it pre-populated that, which is great. So investor attorney fees. And it's all set. The credits and debits match. Now, I said before I like to keep all the cash that comes, the funds to purchase all in the same spot. So I'm going to take this $75,000 loan. I'm just going to grab it and move it up. I'm going to actually move it all the way up to the top. This just helps me to understand, like, how did I come to the table to close this property? Well, it was a $75,000 loan, $28,000 my own cash, plus that $1,000 deposit that was there. So this is all set. This is ready for me to go. So I'm going to click Save. Now again, I'm missing class fields. That's fine. Are you sure? Yes. Okay. I'm just going to pop this up bigger. Save and close. And then if I go back to my summary report, my balance sheet, you can see a few things change. I'm going to have more in my checking account because I didn't need to come to the table with that much to close. Okay, I have the same amount in fixed assets. The property is still worth the same amount. Where things really change is here in long-term liabilities. I didn't have any of these before. Now you see the loan show up here for 123 Main Street. That is my loan to Joe, the private investor. This is that initial deposit I made into my bank account. Stays the same. Now the net income is more negative than it was before. And why is that? That's mostly because of the additional fees that were associated with the loan from Joe. So the mortgage tax, the recording fees, and his attorney fees. I paid for those, and therefore my net income is that much more negative. Okay, so you can see it's pretty simple. You can do quite a bit within that one journal entry to alter things, and it gets pretty simple when you do a few of them. But you can see here, financing is very common. Obviously, you're going to have loans, whether they be private or conventional, so you want to be able to make sure your books reflect those appropriately. So that concludes this video tutorial, and it concludes this 3-part quick series on recording journal entries for the purchase of property. So obviously we'll have follow-ups to get more in depth on this topic and others related to accounting, but that does it for the initial 3. In the meantime, please leave your comments and questions, and be sure to check out all the resources available at incomedigs.com. Thanks for watching.